Hi, this is Rowland for Money Markets TV. It's become painfully obvious over the past several weeks that the United States has serious debt problems. And if the debate over the debt ceiling doesn't get worked out soon, the government could actually default on some of its debt obligations. I don't know how it will all end, but I do know that if you own Treasury ETFs, you're on the wrong end of a potentially bad loan. We can no longer assume that U.S. government debt carries no credit risk. But what are the alternatives? What else are you supposed to do with your cash? We don't have many good choices right now. However, some options in the bond markets are safer than others. In general, if you loan money to a shady character, then you at least want to get your cash back as soon as possible. For our purposes, you do this by keeping your maturity and duration short. In other words, avoid medium and long-term U.S. government securities. That includes Treasury ETFs with average durations of more than 1 to 3 years, and the shorter the better. But even short-term Treasury ETFs aren't free of credit risk or interest rate risk, and the yields aren't exactly impressive either. But conservative investors should take a look anyway. Let me get a little more specific for those of you who don't know much about bond investing. Treasury securities are issued with maturities as short as 3 months and as long as 30 years, plus many points in between. I consider short-term bonds to be those maturing in 3 years or less. A stricter definition might include only maturities of 1 year or less. Whichever definition you choose, you can use ETFs to match your investments to your desired time frame. As I mentioned, short-term Treasury ETFs are yielding next to nothing. However, in the current environment, we're not buying them for income. We're buying them for relative safety. Several different ETF sponsors offer funds that focus on this part of the yield curve, but I wanted to highlight 6 of them that may be worth considering. A few of these, including SCHO at Schwab, SHY at Ameritrade, and VGSH at Vanguard, are even eligible for commission-free trading. Treasury ETFs of any category are, of course, indirectly tied to the fate of the US dollar. The negative impact of a falling greenback may not be readily apparent, but it's still there. So you may also want to consider hedging your currency exposure. A good way to do this is with a gold bullion ETF, one based on the actual metal, not shares of mining companies. Gold is likely to move up quickly in any weak dollar scenario, so having a small slice in a gold ETF is a good insurance policy. Spider Gold was the original gold ETF and is still the largest. iShares Gold is also a good choice. One handy thing about IAU is that each share represents 1/100th of an ounce of gold, while GLD shares are tied to 1/10th of an ounce. Therefore, investors may find it easier to get the precise allocation they want with IAU. I sincerely hope Washington gets its act together and the U.S. avoids default. Meanwhile, now is a good time to review your Treasury holdings and possibly shift your exposure to the short end. The ETFs I named can help you do it. I'm Rowland for Money Markets TV. Thank you for watching.